Welcome back to FOREX School. This is Course 1, Support and Resistance Mastery, and today we arrive at Lesson 3, Breakouts and the Retest. In Lesson 1 we learned how support and resistance levels form, in Lesson 2 we mapped trend structure. Today we put those skills together and study the moment price finally breaks through a level, what a genuine breakout actually looks like, why price so often returns to the scene of the break, and how patient traders use that return to their advantage. The breakout is one of the most traded, and most misunderstood, events on any chart. By the end of this lesson you will be able to tell a genuine break from a trap. Let us be precise about our terms, because this is where most beginners go wrong. A breakout is not simply price poking above resistance or below support. A genuine breakout is a decisive candle close beyond the level, the body finishing on the far side, not just the wick. A wick that spikes through and snaps back is not a break at all, it is a test of the level, and often a rejection of it. What we want is conviction, a full-bodied candle closing well clear of the level, ideally in the direction of the prevailing trend. Where the candle closes tells you who won the battle. Here is a textbook example. Watch how price behaves around this resistance level at 127.80. It approaches, gets rejected, pulls away, and comes back, 3 separate touches, each one confirming the level matters. Notice how the rejections become shallower each time, sellers are defending the level, but buyers keep returning more quickly. Then comes the break. Look at that candle, a strong, full-bodied push that opens near the level and closes decisively above it, with barely any upper wick. That is conviction. Buyers did not just probe the level, they absorbed everything the sellers had and closed well clear of it. Compare this candle to the earlier touches and you can see the difference immediately. This is what a genuine breakout looks like. So price has broken out, why does it so often come back? 2 forces are at work. The first is role reversal, which we met in Lesson 1, old resistance becomes new support, because the orders and the memory around that price do not vanish when it breaks. The second force is trap traders. Everyone who sold at that resistance expecting another rejection is now underwater. When price dips back to their entry, many of them close at break-even, and buying back a short position means buying. Add in the patient buyers who missed the break and are waiting to join at a better price, and you have a natural pool of demand sitting right at the old level. That is the retest. This brings us to the heart of the lesson, the retest entry, the patient trader's way of joining a breakout without chasing it. The logic runs in 3 steps, and each one is a filter. Step 1, wait for a genuine break, that decisive close beyond the level we defined earlier. Step 2, do nothing. Let price pull back towards the broken level on its own. This is the hard part, because doing nothing feels like missing out. Step 3, watch how price behaves at the old level. What you want to see is rejection, buyers stepping in, wicks forming underneath, and ideally a strong bullish candle confirming that old resistance is now acting as support. And crucially, the level itself gives you a clear line in the sand. If price closes firmly back below it, the breakout idea is simply wrong. Let us return to the same chart and watch the whole sequence play out. After the breakout candle, price pushes higher for a couple of bars, the eager money is in. Then momentum fades and price begins drifting back down towards 127.80, the old resistance. Here is the moment of truth. Watch this candle at the retest, it dips into the level, wicks just below it, and closes back above. Sellers tried to push through and were absorbed. Then comes the confirmation, a strong bullish candle closing well off the level. Old resistance has officially become new support, exactly the role reversal from Lesson 1. From there, buyers who waited patiently are rewarded as the move continues higher with fresh momentum. Now for the villain of the piece, the fake out, sometimes called a false break or a bull trap. Price breaks the level, tempts everyone in, and then snaps straight back, leaving the breakout buyers stranded above the market. The warning signs are readable if you know where to look. First, close location, a break that closes only marginally beyond the level, or with a long wick poking through and a small body, shows hesitation rather than conviction. Second, follow-through. A genuine break is usually supported by strong participation, so if volume is thin and the very next candle stall or slide back inside the range, be suspicious. A real break holds its ground. A fake one gives it back almost immediately. Here is the trap in action, on a resistance level at 130.20. The setup looks familiar at first: repeated tests, a tightening approach, and then a break. The candle even closes above the level. But look closely at what follows. The very next candle pushes higher, fails, and leaves a long upper wick, closing right back down at the level. That is your first warning: no follow-through. Then the trap springs. Price closes firmly back inside the old range, and every trader who bought that break is now trapped above the market. Their exits become sell orders, which is exactly why the fall is so fast and so relentless. Notice how far price travels once the trap is sprung. False breaks in one direction often fuel strong moves in the other. There is a third scenario you must plan for: the runaway break. Watch this resistance at 125.60. The pattern starts the same way: multiple tests, pressure building beneath the level. Then the break arrives, and it is powerful: a wide-bodied candle closing far above the level, followed immediately by more strong buying. Now watch for the retest. It never comes. Price pauses briefly, but the pullbacks are shallow and never return anywhere near the broken level. Demand is simply too strong. The market runs, and the trader waiting patiently for a retest at 125.60 watches the entire move happen without them. This is the honest cost of patience, and it is a cost worth understanding rather than resenting. So we face a genuine trade-off, and it is worth naming honestly. The momentum approach, entering on the breakout candle itself, catches every move, including the runaways, but it also catches every fake out, and it usually demands a wider invalidation point because you are entering far from the level. The patient approach, waiting for the retest, filters out many traps and offers a cleaner, closer invalidation, but it will miss the strongest breaks entirely. Neither approach is right or wrong, they are different tools with different costs. What matters is that you choose your approach before the break happens, write it into your plan, and accept its costs calmly. Missing a runaway is not a mistake. Abandoning your plan mid-trade is. Before we recap, let us walk through the mistakes that catch almost every new trader around breakouts, so you can recognize them in yourself early. Mistake 1. Buying the first close above the level with no plan, no invalidation point, no target, just excitement. Mistake 2. Chasing. Price broke 3 candles ago, it is already extended, and you jump in late at the worst possible price, just in time for the pullback. Mistake 3. Treating every wick through a level as a breakout, when we know only the close counts. Mistake 4. Revenge trading after being caught in a fake out, trying to win the loss back immediately. And mistake 5. Refusing to accept a runaway, and forcing an entry at a level price has long left behind. Every one of these is cured by the same medicine: a written plan, made before the break, followed after it. Let us gather everything together. A genuine breakout is a decisive close beyond a level, not a wick through it. Retests happen because of role reversal and trap traders, and they offer the patient trader a second chance at a better price with a clear invalidation. Fakeouts announce themselves through weak closes, long wicks, thin participation, and no follow-through. Runaway breaks are the honest cost of patience. And whichever approach you choose, momentum or retest, choose it before the break, never during it. That completes Lesson 3 of Support and Resistance Mastery. If this is helping your understanding of the charts, do subscribe and turn on notifications, because Lesson 4 takes everything further as we explore supply and demand zones, the areas where the biggest orders in the market actually sit, and how they refine every level you have learnt to draw so far. As always, remember, everything in this series is for education only. Nothing here is financial advice, no outcome is ever guaranteed, and trading carries real risk of loss. Study first, practice on a demo, and take your time. See you in Lesson 4.